Systems Online. New mission. Understand something called the stock market. Here's what I've gathered so far. People give money to companies. Sometimes the money grows. Sometimes it disappears. Humans call this investing. It looks a lot like something else I've seen. It looks like gambling with extra steps. Let's start simple. A stock is a tiny slice of ownership in a company. If a company has 1,000,000 slices and you own one, you own 1/1,000,000th of that company. If the company grows and makes more money, your tiny slice is usually worth more. If the company struggles, your slice is worth less, sometimes worth nothing. So far, this part makes sense. It's the next part that gets weird. Here's what I didn't expect. Prices don't just move because a company did something good or bad. They move because thousands of people are guessing what will happen next, all at the same time. Good news comes out, people rush to buy. The price jumps. Scary news comes out, people rush to sell. The price drops. So a stock price isn't just a measurement, it's also a mood. A very jumpy, very loud mood. That's the part that feels like a casino. Not the ownership, the feelings. Quick detour. You'll hear humans call the market bullish or bearish. I had to look this up. A bull attacks by swinging its horns upward. So bullish means prices are expected to rise. A bear attacks by swinging its claws downward. So bearish means prices are expected to fall. So the entire mood of the financial world is described using two animals fighting. I respect that, honestly. So is it really gambling? Here's the actual difference. Gambling is a short bet. Minutes, hours, maybe a night. The odds are usually built to favor the house. Investing, done well, is a long bet. Years, sometimes decades. Historically, the overall market has trended upward over long periods. But that's the key word, long periods. Short term, the market can drop hard and stay down for a while. So the casino feeling is real, especially day to day. But long-term investing and short-term gambling are not the same game, even though they can feel similar in the moment. Let me show you why don't panic is easier said than done. 2000, the dot-com bubble. Excitement over internet companies collapsed almost overnight. 2008, the housing market crash. Trusted institutions failed within days of each other. 2020. A global shutdown erased years of gains in about a month, then recovered within months. 3 totally different causes, same pattern each time: sharp fear, sharp drop, and eventually recovery. You've probably heard, the market always goes up eventually. That's technically true, but it hides something. Along the way, there have been sharp drops, some lasting months, some lasting years before recovering. If you needed your money during one of those drops, eventually doesn't help you. So the real lesson isn't it always goes up, it's don't invest money you'll need soon. Before I go further, I need to show you the strangest number in this whole system. If you invest $200 a month starting today, and the market averages historical returns, by retirement, you could have contributed maybe $70,000 total. But your account could actually be worth several times that, not because you added more money, because of something called compound interest. Your gains start earning their own gains, slowly at first, then faster again. Time does more of the work than the amount you invest, which means the earlier you start, the less effort this actually takes. Here's something I didn't expect. Some companies pay you just for owning their stock. This is called a dividend, a small slice of the company's profit sent directly to shareholders. Not every company does this. Younger companies usually reinvest profits instead to grow faster. Older, more stable companies are more likely to pay dividends regularly, sometimes every 3 months. So it's not just about the price going up. Sometimes the company pays you just to stick around. Now, the part that surprised me most. The boring answer might be the smartest one. Picking individual stocks means betting on one company at a time. Get it right, big reward. Get it wrong, big loss. An index fund is different. It's a basket holding hundreds, sometimes thousands of companies at once. If one company in the basket fails, it barely moves the whole thing. You're spread across the entire market instead of one bet. It's less exciting, no dramatic wins to brag about, but historically, it's also one of the hardest strategies to beat, even for professionals. Here's the uncomfortable part. The biggest risk in your portfolio usually isn't the market. It's you. Specifically, what you do when prices drop. Studies on investor behavior consistently show the same thing. People tend to sell in a panic near the bottom and buy back in after prices already recovered. So the fear costs money. Then the relief costs money too. The habits I'm about to give you aren't really about the market. They're about managing yourself. I can't predict the market. No one really can, long term. But here's how humans protect themselves. Only invest money you won't need soon. That way, a short-term drop doesn't force you to sell at a bad time. Diversify. Don't put everything into one company. Spread it out. Ignore daily price swings. They mean very little if your plan is years long. Avoid chasing hot tips. If it sounds like a secret shortcut, it usually isn't. And keep investing small amounts regularly, instead of trying to guess the perfect moment. Consistency beats timing. So the stock market isn't a casino, but it can feel like one if you treat it like a casino. Own a small piece of something real, give it time, and try not to watch it every hour. Next time, I'm looking into something humans call a mortgage. From what I've seen so far, it sounds like a 30-year handshake with a stranger.